Yes, we run a big nowcast model for the global economy, and that is currently showing the largest slowdown in global growth since basically 2012, the Eurozone crisis. So we have global growth right now tracking a little under 3%. It was running as high as 4.5% late last year.
And what do you point that down to when you look at the loss of momentum? Is it a function of the US, which was the one bright spot for 2018, losing some momentum because the fiscal stimulus is unwinding? Or is it just a function of the rest of the world being in late cycle and losing steam?
Yeah, it's a little bit of everything. So this is 200 indicators across 25 economies. So it's definitely not just the US, it's across the board. We attribute most of it to the slowdown in the global trade cycle, sort of predating the tariff tension. But we're also seeing some signs of late cycle dynamics, some capacity constraints, confidence obviously going down because of the tariffs. So it's a little bit unclear what to pin it down to exactly. We're generally unconcerned about it, so we think it's cyclical. We have these ups and downs, over the last couple of years, and we assume that we'll bounce back in the next couple of quarters. But it's clearly unnerving at a time when the markets themselves are selling off.
But what I find interesting is that even though you see this momentum skidding, your forecast for next year is still at 3.6%. That's still pretty high.
Yeah, so that's about a 30 basis point slowdown versus this year. And if you go back to where we were tracking late last year, we were tracking in excess of 4. So it is a pretty sharp slowdown from those levels. But to put it in context, the long-run average growth rate in the global economy is about 3.7. So what we're forecasting is something that is now converging on this long-run average.
What would you say is the main risk to your outlook next year?
So we have way more than one risk. So we do 6 scenarios in the outlook. We try to break the model, see all the different ways in which we could be wrong, and there are many. We have, the uncertainty range around our global forecast, global growth forecast is about 140 basis points. Around our Fed funds forecast is 400 basis points. But the main ones I would highlight, so obviously we have either trade escalation or de-escalation, so that's a big one. We have oil shocks, so we run, the oil uncertainty band, I think, is massive. Central banks could fall behind the curve here. One of the things that we're concerned about, so the title of the report is the end of low for longer, is that we are getting very close to pre-crisis levels on a whole range of economic variables. So core inflation is nearly back to pre-crisis levels, output gaps have closed, wage pressure is rising. And so we're getting to the point where, unless we're exactly right on the inflation forecast, you're going to get an overshoot, I think, in terms of the central bank reaction.
So in other ways, you're saying that central banks may more or less fall behind the curve going into 2019?
Yeah, so on the baseline, of course, everything looks fine. If you have just a 50 basis point overshoot relative to their own forecast on inflation, they will hike by much more than 50 basis points. So we're at the point where there's no longer any kind of wiggle room.
What do you think that does for financial stability? And obviously this is coming at a very tumultuous time in the stock markets over the last month anyway. And a lot of that is pointed back to trade tensions, but then also heavy positioning, higher interest rates, yields in the US, a Fed hawkish policy. If the rest of the world starts turning more hawkish because they have to, other central banks, what do you think that means for financial markets?
Yeah, so what's interesting is almost by design, the central banks have put themselves behind the curve, and so they've locked themselves into these very slow normalization trajectories. So it's very difficult within 2019 for many central banks to see them accelerating. So the ECB is a good case in point. It's almost inconceivable for them to hike in 2009. I mean, they'll hike at the end of 2019, but they won't do much before then. So 2020 is really where the uncertainty opens up. Now, the Fed obviously is already hiking, and so they could accelerate. And so I think there's a risk here that near term, you get the U.S. running away from everyone and doing a bit more, and everyone else then needing to catch up in 2020. And so that rate divergence and business cycle divergence is what creates the volatility. And I think we're getting to the point where that volatility will start to go up.
What about the big elephant in the central banking room, the Bank of Japan? You've got a very high forecast for growth for Japan, very above consensus from what I can tell.
Yeah.
With your higher growth forecast and the potential consumption tax that's going to come into play next year in Japan, what do you think that means for Bank of Japan policy?
Yeah, so it's really
finally do something.
Yeah, they will finally do something. So what's interesting, so we are way above consensus, both on inflation and growth. So we think Abenomics is working. The reason, I think what most people are missing next year is that they now have 2 supplementary budgets. So combined with what they've already done in the actual budget, we think the fiscal impulse is now net positive. So they're going to have this VAT hike, which in 2014 took about 2% off of GDP. They fully neutralized that next year. Then on top of that, you're going to get the bounce back from all these natural disasters they've had this year. Wage mass growth is higher in Japan than in the US, which is phenomenal. So we see an incredibly tight labor market. And so you're going to get consumption basically flying. And so all that combined is going to start to push core inflation up. And then by the time you get to April, we think you're going to get the first actual move in yield curve control. So we think the JGB target goes to 25 basis points. And by the time you get to the end of next year, you're going to be at 40 basis points. That's the forecast.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.